Hello and welcome to another Paraplanners Assembly short technical video. I'm pleased to be joined by Elaine Cruickshank from Aegon again, and today we're talking about IHT planning. And I'm going to start off with a quote from back in the 80s from Lord Jenkins in his budget speech, where he said, "Inheritance tax is, broadly speaking, a voluntary levy paid by those who distrust their heirs more than they dislike the inland revenue." Not entirely sure about that, especially when you think about last tax year, 5.2 billion was paid in this voluntary tax. So there we go. So Elaine, let's talk about the main strategies that people can look at if they really don't want to pay IHT.
Thanks, Richard. Yeah, there's a whole host of different IHT mitigation strategies that clients can actually consider if they want to mitigate their IHT liabilities. So obviously, firstly, they could just simply spend their wealth during the lifetime, go on world cruises, and that's certainly a way to lead the life, but actually their beneficiaries, so their family, might not be entirely happy if there's nothing left for them at the end of the day. They could do some trust planning via their will. They could make lifetime gifts if they're willing to actually gift away substantial amounts of cash or assets during the lifetime. They could actually make use of reliefs such as agricultural property relief or business property relief to actually offset against the value of these assets within their IHT estate. They could create a legacy with life insurance, so actually they could just take out a whole of life policy and place that in trust for the beneficiaries, so that the beneficiaries then have the cash to meet the IHT liability when they die, or actually so that the beneficiaries then have the funds to make good the shortfall in relation to the assets that they'll get from the estate after the IHT liability has been paid. Clients could actually gift some of their assets to charity during the lifetime. If they gift assets to charity during the lifetime, then that's an exempt transfer for IHT purposes. And obviously they may well be able to claim gift aid relief as well. So the charity would get relief at basic rate, and then the transferor of the assets to the charity would be able to get relief at the difference between the highest marginal rate of tax and 20% basic rate tax. Or within their will, they could actually leave assets to charity. If they leave assets to charity, then those are exempt transfers, so would reduce the value of their estate subject to IHT. Or alternatively, they could actually leave more than 20% of the net estate to charity, in which case they'll actually benefit from a reduced rate of income of inheritance tax. So instead of suffering inheritance tax at 40%, they'll suffer inheritance tax at 36%. So that could be quite attractive. Obviously, client could consider doing trust arrangements, so DGTs, loan trusts, gift trusts during the lifetime. Family investment companies and family limited partnerships, those were popular for a while as an alternative to trusts, especially when the IHT changes to trusts were introduced in 2006. And then finally, pensions can be IHT efficient as well, because pensions where the scheme administrators operate a discretionary disposal power, the value of the pension doesn't generally form part of the member's estate on death. There are a few types of pensions that may form part of the member's estate on death if they're not held in trust, so like your Section 226 policies or your Section 32 policies, but on the whole, pensions tend to be IHT friendly arrangements.
Certainly at the time of recording this, which is late summer 2020, pensions have become a fantastic IHT planning tool for sort of better off clients. That may change very soon, although watch out for some of the little trapdoors, you know, the transfer in health, the 2-year Royal Stavely case quite recently. So if you're not familiar with those, go and have a quick read. It's worth it. So let's have a look at some of the main exemptions and start with lifetime transfers.
Yeah, so there's a host of lifetime IHT exemptions that apply. So for example, you've got your annual £3,000 exemption that if it's not used in the current year, it can be transferred forward for 1 year only. So in other words, if I don't use my £3,000 exemption this year, then I could actually make a gift of £6,000 next year using this year's unused allowance and next year's allowance. You've got the small gifts exemption, so you can make unlimited gifts of £250 to a number of different individuals. So for example, I can make one gift of £250 to Richard, but I couldn't make 2 gifts of £250 each to Richard. One of the gifts, in that situation, the small gifts exemption wouldn't apply because I've reached my £250 limit. You've got gifts in consideration of marriage or civil partnership. So where a couple are going to get married, then each parent of a party to the marriage can give £5,000. Grandparents and other remoter relatives can give £2,500. The bride and groom can give £2,500 and others can give £1,000. So this has to be in contemplation of the marriage actually taking place. So it has to be shortly before the wedding, and the wedding actually then has to go ahead for this exemption to apply.
It'd be a nice little get out otherwise, couldn't it?
That's right.
Never mind. So here's one of my favourite ones, which is the gifts out of normal expenditure.
So this is quite a popular exemption, and it can be really invaluable, for example, where an individual is funding a life policy in trust. So there are 3 conditions that actually have to be met in order to claim normal expenditure out of income exemption. So first of all, the gifts have to be made out of income after tax. And the gifts have to be made on a regular basis. So for example, if the client had made 3 years worth of gifts, then they formed a regular pattern of making the gifts. Or the client can document that actually they are prepared to make a regular series of gifts. And if they document that they're intending to make regular gifts, and if they were to die, for example, after only one of those gifts had been made, then they may still well qualify for normal expenditure out of income exemption in relation to that gift. And then finally, the donor has to be left with enough income to maintain their normal standard of living after the gift has been made. So they can't actually use their capital to maintain their lifestyle following the gift. They have to still be living out of their income rather than using accumulated savings.
So that leads me into a question I often see asked: do withdrawals from investment bonds count?
Unfortunately, they don't count for normal expenditure out of income exemption. It's a good question, Richard. Withdrawals from an investment bond are capital in nature rather than income. And so therefore, if gifts are made of withdrawals from a bond, then they will either be potentially exempt transfers or exempt under the £3,000 annual gifts exemption, for example.
Yeah, doesn't work, does it?
and the same applies as well with withdrawals from a discounted gift trust as well, where the discounted gift trust, where the underlying investment's a bond. It's the same principle, unfortunately, that the withdrawals from the bond that form part of the settlor's regular income, those are capital as well, unfortunately.
Okay, and there are some other exemptions as well.
There are some other exemptions that apply to lifetime transfers and also on death. So for example, you've got the IHT spouse exemption. So transfers between spouses are generally exempt. If the transfer is from a UK domiciled spouse, though, to a non-UK domiciled spouse, there's a limit to the allowance, and the allowance is 325,000. Used to be 55,000, but it's increased now to 325,000. Gifts to charities are exempt, so gifts to UK charities and EU charities and charities in a number of other jurisdictions are exempt. Gifts for the national good are exempt, and gifts to political parties are exempt, but again, it has to be a political party where there's either two ministers, you know, in Parliament, or if effectively they receive 150,000 votes for candidates in the last election. And finally, gifts to housing associations are also exempt.
Okay, and let's just finish off by looking at some other considerations.
Yeah, so just finally, if someone dies in active service, or if it's an emergency worker that dies while they're in active service, so for example, a policeman that's shot, for example, whilst they're on duty, then on their death, their estate won't be subject to IHT. Gifts for family maintenance, so for example, if a spouse is looking after children under 18, or if they make maintenance payments for an ex-spouse, these aren't transfers of value, so they're not subject to IHT, these gifts for family maintenance. Obviously, you've got invaluable reliefs for IHT purposes, such as agricultural property relief and business property relief, meaning that the individual will either be able to benefit from 100% relief or 50% relief, depending on what the assets actually are. So that could be invaluable. And finally, obviously, it's worthwhile considering making potentially exempt transfers and or chargeable lifetime transfers during lifetime. So obviously, these gifts work on a seven-year clock. So if a potentially exempt transfer is made, it falls out of the estate after 7 years, and the individual then has their full nil rate band available again. So obviously, the earlier they start making gifts that aren't exempt transfers, the better, so that then they can make use of their full nil rate band every 7 years. And chargeable lifetime transfers, obviously, they tend to be gifts into discretionary trusts. And again, they're limited to 325,000 if the individual wants to avoid an immediate IHT charge. But again, the individual will get a new nil rate band every 7 years.
Thank you. One thing I just add to that one is documentation is key, especially if you're making gifts, especially those out of regular income. Make sure you document everything and you keep it with the client's papers.
That's right. I would agree with that, Richard. That the more information that the executors have available when it comes to dealing with the estate administration, the better. And could even be the case that the client, if they're using normal expenditure of income exemption, they may well want to use the IHT supplementary form that HMRC use, which is IHT 403, and this gives a template actually, which will give you like income and expenditure, and the bottom line, it will say excess, it will give you your excess income that you could actually give away at the end of the year. So again, that would be good documentary evidence for the personal representatives in the event that they need to make a claim for that.
Yeah, we certainly recommend using that. Best way to go, I think. That was brilliant. Thank you once again, Elaine, for sharing your expertise with us, and thank you for watching, and we'll see you all again very soon.